Hi, I'm Ken Frier, Chief Investment Officer of Atlas Capital Advisors. It's June 2025, and this video is number 7 in the series we call Alternative Investments Reality Check. In what follows, I'll discuss the decision by the Yale University Endowment Office to sell $2.5 billion, or more than 10% of its private equity holdings. Yale is in the top echelon of investors in alternatives, so the portfolio being offered is most likely a desirable one. Yet when it comes to secondary transactions in private assets, it is typically much better to be a buyer than a seller. You particularly don't want to be a forced seller. Yet Yale is being compelled to sell at a discount reported to be about 10% due to an array of financial pressures on the university. As we'll discuss further in this video, this action by Yale illustrates another downside to illiquid investing. The more you have, the more vulnerable you are to financial stress. And Yale has quite a lot of illiquid investments. As of June 2024, about half of the $41 billion endowment was in private equity, split between buyout funds and venture funds. Less than a quarter of it was in liquid investments in public equity and fixed income. Unfunded capital commitments to existing managers were $10.6 billion, a larger amount than the liquid assets on hand to fund capital calls. Yale is renowned as one of the world's most skilled and experienced investors in alternatives. And yet, despite these capabilities, their 10-year annualized return of 9.5% per year is just okay. A return of 8.3% was available from simply having 90% invested in the global equity index and 10% in the US core fixed income index. Over the same 10 years, the S&P 500 was up 12.8% per year, while the NASDAQ 100 gained 18.9% per year. If we go back 20 years to June 2004, Yale's trailing 10-year return beat a 90-10 stock bond mix by 6.2% per year. And then 10 years after that, in 2014, Yale was ahead of a 90-10 stock bond mix by 3.6% per year. So since in the most recent 10 years is just 1.2% per year, the trajectory is clear. It's increasingly difficult to succeed with alternative investments, even for Yale. That's a key point of our reality check series. If the best of the best, like Yale, can achieve only a small additional return from alternatives, the odds of anyone else thriving with alternatives are low. A key factor in Yale's current liquidity crunch is the drop-off in distributions from private investments. On average, distributions from private equity as a proportion of invested capital have fallen sharply since 2021, even though the public market has risen strongly. Based on these averages, that would be $2 to $3 billion per year of distributions that Yale likely expected that did not happen. Looking at Yale's revenue, the endowment transfers about 5% of its assets each year, which is $2 billion presently, to fund the university. That endowment contribution is now 1/3 of the revenue of the university, larger than any other source. So if the endowment faces a liquidity crunch, then so does the university. The Trump administration is pressuring Yale on multiple fronts. Going clockwise around this pie, there's a proposal to tax the endowment's investment income. Cuts in government medical spending and the impact of tariffs on medical supplies will affect the medical slice. The 20% of Yale's revenue from grants and contracts comes mostly from the government, and that is in peril. International students are 28% of the student body and probably more than 28% of tuition income. So the threat to expel foreign students is yet another danger to Yale's finances. While the financial strain on Yale is severe already, it would become even more daunting if there were a bear market in equities. The odds of a bear market are rising, as we indicated in our most recent video. In a bear market, private distributions would dry up further. Public equity would be the main source of liquidity for funding the university, and that would make the Yale endowment a forced seller of public equity at bear market prices. The overhang of committed but uncalled capital would become an ominous liquidity threat. Chief investment officers would urge their general partners to not call capital despite attractive investment opportunities, which is just what happened in 2009. Also, the university might feel compelled to issue debt to shore up its capital, which also happened in 2009. To summarize, Yale's financial liquidity is being pressured by the unexpectedly meager outflows from private investments and U.S. government threats to its sources of revenue. The Yale Endowment's very large allocation to illiquid investments has become a source of fragility for university finances. This allocation is simply too large to provide the financial flexibility and resiliency that the university needs this year. In response, the Yale Endowment seeks to sell over 10% of its private equity holdings in the secondary market, an action which is rarely desirable for the seller. While this secondary sale seems motivated by present circumstances, it may also be a recognition by Yale that the boom in alternative investments, which they did so much to validate and promote, has reached a point of limited usefulness. Thank you for listening. At Atlas Capital, the focus is to keep implementation costs as low as possible and on making favorable asset allocation decisions. To get other recent market commentary, you may watch the market commentary playlist on this channel, and you may subscribe to get notified as soon as the latest is posted. You may also visit our website at atlasca.com to have access to our investment philosophy and market views. Thanks.